The banks are giving these amazing rates. The rates are amazing. 1 year CD, 4.5%, 5%. That to me is a pretty good rate. We have, through an insurance company, we have a 1 year, and we have anywhere from 1 year to 20, but we have a 1 year insurance product. I'll call it a CD alternative. It's paying 5.1%. You get out a year. There's a window. There's a window that you can take your money out, or you can take part of it out, or you can, look at the terms to roll it over. You can look at the new rates. We'll explain all that to you. But it's like a CD, except your CD is 1.1. Anthony, we need to look at the quarterly report and refresh that too. Maybe I'm giving old numbers now. Maybe it's lower now. Hey, maybe it's higher. But they're about 1.15% of your money is covered. The insurance company, 100% of your money has coverage. It's in reserves. By the way, that rate that I gave you, I have to be careful. Today is the 5th of June. That rate is active. They usually revisit the rate at this particular company about every 30 days. But I just want to warn you, if you come to us in July, we might not have the same rates, obviously. But why would you do a CD when you know that you have no coverage on it, when you can do an insurance company product that mirrors the action of a CD with 100% coverage on your money? I just don't get it. Well, my everybody, not just Susie Orman, Dave Ramsey, Ken Fisher, my spouse told me how evil annuities are. An annuity, that's a bad word. Well, let me give you a real quick annuity 101 before we move on, because this isn't even what I meant to talk about yet. So, annuity 101. There's good annuities and bad annuities in our estimation. We will never, us, Anthony, me, Sandy, we will never talk to you about a variable annuity. I haven't presented one, offered one, sold one in about 20 years now. The risk, the fees, there's not one that Anthony and I have found that we would own, so we're not going to sell it to you. So maybe we'd get better commission. Maybe we're missing the boat on that one. But we need you to knock out variable annuities and only look at fixed. The second thing, when you look at fixed, there's an annuity called a life only. If you have no kids, if you're not married, if you don't care about the Humane Society, the Cancer Society, it just means you give them your money. And for life, they give you a pension. But the problem is if you die in 2 years, they keep your money. Well, I have never, in 26 years, never presented one of those. I've never thought it was a good idea because life happens and I don't want the insurance company to take your money. I also don't want the government to take your money. So talk to us about the tax deferral. Talk to us about the compounding on insurance companies versus CDs. So basically what I'm getting at here, there's fixed is what I would say to look into. There's 3 different basic categories. There's a single premium immediate annuity. Look at that as a pension. You give them a lump sum, they give you monthly payments. You can pick either a duration like 5 years or 10 years or 15, or you can save for life. Well, then you add a beneficiary. What if I die in year 2? Then it goes to your husband, your wife, your kids, whatever, your grandkids. So the next thing is a fixed indexed annuity. And that is a bucket of money where we can have different sections of money within it. We'll explain it to people. And by the way, when we do insurance company products, we like to ladder them out. If you bring us $100,000, we rarely would ever put $100,000 all in one area. So what I want people to understand is this. The last one is called a multi-year guaranteed annuity. It works like a CD. You tell me if you want 1 year, 2 year, 3 year, 5 year, 10 year, and I give you the rate. And then you get that rate each of those years until the expiration of the term. So just like a CD. And I would encourage you, like the old days of bond laddering and CD laddering, I would do a MIGA ladder. I would do some in a 1 year, some in a 2 or a 3 year, some in a 5 year, and then we wait and see how the world progresses. But this whole thing about I hate annuities, I was told never to do annuity. A lot of times I'm in Sun City. I steal all the information I can from Tom Hegna, one of the most brilliant people in the insurance industry ever. He's like, well, Mr. and Mrs. Client, you hate annuities. I get that. You don't take your Social Security, do you? What do you mean? Your Social Security. You're $1,800 a month. Do you take it? Well, sure. Well, it's an annuity. I thought you hated annuities. Annuities are evil. I don't want that annuity. I want to stop taking my Social Security number, my Social Security money, because that's an annuity. If you win the lottery, let's say you win let's be reasonable, because I know if you win the Mega or the Powerball, it's probably going to screw up your life beyond repair. But let's say you win the pick. The Arizona pick right now is at about $2 million. So you win the $2 million. You have a couple choices. One, you can take it as a lump sum. If you do so, you get half. So who would want to do that? I just won $2 million. Can I have it? Well, you can have half, or you can take an annuity. We can put it into a 20-year annuity. We'll give you substantial and equal payments for 20 years, and then it's gone. Well, what if I die in 2 years? I could have had $1 million, but I took $2 million, and then I died. Well, good for your spouse. Lucky for you, spouse, or kids, you get to keep the remainder. That is an annuity.